Could you perhaps give an indication as to how you come up with the economic value or the intrinsic value of the businesses that you finally decide to invest in? This is the most frequently asked question to Warren Buffett at the Berkshire Hathaway annual meetings. In this video, we learn from Warren Buffett's answers how he values a stock by calculating its intrinsic value, and we analyze Warren Buffett's investment in a candy firm, See's Candies. See's Candies changed Buffett's investment style for good. In the end of the video, you will know how you can calculate the intrinsic value of a business like Warren Buffett. Welcome friends, my name is Jolt. I beat the stock market for years by analyzing the greatest value investors like Warren Buffett. Let's dive in. So the big question is how you can come up with the economic value or the intrinsic value of a business. Buffett explained that all investing can be explained by a fable. Here we go.
Actually, it's very simple. The first investment primer, when would you guess it was written? The first investment primer that I know of, and it was pretty good advice, was delivered in about 600 BC by Aesop. And Aesop, you'll remember, said, "A bird in the hand is worth two in the bush." Now, incidentally, Aesop did not know it was 600 BC. He was smart, but he wasn't that smart. Now, Aesop was onto something, but he didn't finish it, because there's a couple of other questions that go along with that. But it is an investment equation. A bird in the hand is worth two in the bush. He forgot to say exactly when you were going to get the two from the bush, and he forgot to say what interest rates were that you had to measure this against. But if he'd given those two factors, he would have defined investment for the next 2,600 years, because a bird in the hand is, you will trade a bird in the hand, which is investing. You lay out cash today, and then the question is, as an investment decision, you have to evaluate how many birds are in the bush. You may think there are two birds in the bush or three birds in the bush, and you have to decide when they're going to come out and when you're going to acquire them. Now, if interest rates are 5%, and you're going to get two birds from the bush in 5 years, we'll say, versus one now, two birds in the bush are much better than a bird in the hand now. So you want to trade your bird in the hand and say, I'll take two birds in the bush, because if you're going to get them in 5 years, that's roughly 14% compounded annually, and interest rates are only 5%. But if interest rates were 20%, you would decline to take two birds in the bush 5 years from now. You would say that's not good enough, because at 20%, if I just keep this bird in my hand and compound it, I'll have more birds than two birds in the bush in 5 years. Now, what's all that got to do with growth? Well, usually growth people associate with a lot more birds in the bush, but you still have to decide when you're going to get them. And you have to measure that against interest rates, and you have to measure it against other bushes and other equations. And that's all investing is. It's a value decision based on, what it is worth, how many birds are in that bush, when you're going to get them, and what interest rates are.
This is what we can learn from the video. 3 things you need to know to calculate the intrinsic value of a company. 1. How certain are you that there are indeed birds in the bush? 2. When will they emerge and how many will there be? 3. What is the risk-free interest rate which we consider to be yield on the long-term US bonds? If you can answer these 3 questions, you will know the maximum value of the bush and the maximum number of birds you now possess that should be offered for it, Warren Buffett explains. And of course, don't literally think birds, think dollars. The same question was asked at another Berkshire annual meeting. Warren Buffett gave another explanation.
If we could see, looking at any business, what its future cash inflows or outflows from the business to the owners, or from the owners, would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate the strengths and weaknesses of the company and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business. And the filters you described, there are a number of filters which say to us, we don't know what that business is going to be worth in 10 or 20 years, and we can't even make an educated guess. Obviously, we don't think we know to 3 decimal places or 2 decimal places or anything like that, precisely what's going to be produced. But we have a high degree of confidence that we're in the ballpark with certain kinds of businesses. The filters are designed to make sure we're in those kinds of businesses. We basically use long-term, risk-free, that's government bond type interest rates to think back in terms of what we should discount at. And you know, that's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce.
I like to add a conversation between Buffett and Munger. Buffett explains, we don't formally have discount rates. Every time we start talking about this, Charlie reminds me that I've never prepared a spreadsheet, but I do in my mind. We just try to buy things that we will earn more than a government bond. The question is, how much higher? Munger, Warren often talks about these discounted cash flows, but I've never seen him do one. If it isn't perfectly obvious that it's going to work out well, if you do the calculation, then he tends to go on to the next idea. Buffett, it's true. If the value of a company doesn't scream at you, it's too close. Buffett's current investment approach is totally different than the investment approach he practiced early in his career. See's Candies Company was the first high-quality business they ever bought. They used the intrinsic value calculation. Let's analyze their investment in See's. See's Candies is an American manufacturer and distributor of candy, particularly chocolates. It was founded by Charles C., his wife Florence, and his mother Mary in Los Angeles, California in 1921. Buffett and Munger were tipped off that See's was for sale in 1972. Warren and Charlie had the opportunity then to buy See's Candy for Blue Chip Stamps, a company in which Warren and Charlie and Berkshire had a major stake, and which was later merged into Berkshire. See's Candies was a legendary West Coast manufacturer and retailer of boxed chocolates. At the time, See's was posting $30 million in sales with pre-tax earnings of $4 million or $2 million post-tax, and had $8 million in assets. The family controlling See's wanted $30 million for the business, and Charlie rightly said it was worth that much. But Buffett didn't want to pay more than $25 million. The sellers decided to take the $25 million bid. Buffett and Munger paid more than 6 times its pre-tax earnings, 12 times its post-tax earnings, or 3 times its book value. 12.5 times its earnings post-tax gives a rate of 8% return on investment. The 10-year U.S. Treasury rate in January 1972 was 5.95%. Buffett and Munger chose investing in See's Candies over 10-year U.S. Treasury bonds. Let's see how this worked out for the two men 13 years later. Total earnings of See's Candies after 13 years were $93.6 million versus a total interest income of $90.3 million. Had they invested $25 million in 10-year U.S. Treasury bonds, they would $74 million poorer. Of course, they could reinvest their interest earnings in T-bonds, but I think you get the point. See's Candies has a loyal customer base. The customers would remain loyal even with the price hikes every year. The candy firm raised its price per pound by 10% per year, far above the rate of inflation. See's has raised its prices from less than $2 a pound to more than $20 a pound today. The pre-tax earnings were estimated $430 million by 2018. So how much did See's Candies return to Buffett and Munger or Berkshire Hathaway? We put $25 million into it and it's given us over $2 billion of pre-tax income, Buffett said at the 2019 annual shareholder meeting. They made on their investment around 8,000% since 1972 or more than 9% a year. Interest earnings would be far less had they invested in T-bonds. A few takeaways of Warren Buffett on the intrinsic value calculation. 1. Keep it simple. You don't need a spreadsheet. 2. Try to buy things that will earn more than a long-term government bond. 3. Value of a company must scream at you. 4. Last but not least, keep in mind, price is what you pay and value is what you get. Question of the day. Which stock had the highest return on investment you purchased? Let me know in the comment section below. If you find this video helpful, please share with your friends and hit the like button below and make sure you subscribe so you get more videos like these. Click the alarm bell for notification. And if you want an exclusive valuation template on PDF, please make sure you sign up with the link below in the video description. Thank you for watching. See you next time.